Right, markets have been choppy in recent trading, but according to our featured guest today, what we're seeing may not actually be a correction. Joining us now to discuss is Brad Simpson, Chief Market Strategist with TD Wealth. And Brad, welcome to the show.
Great to be here.
All right, well, as I mentioned, we've seen a lot of volatility in markets recently, but you say that this is not a correction, but more of an unwinding. What's been happening there?
Yeah, I mean, let's start with, I think we look into your introduction. If you X'd out Canada, as soon as you went to the United States, you went to technology. Updating technology, updating NASDAQ, updating technology names. And, if you look at the correction that we've had here, I mean, if we back up a little bit and look at what it is my team do at the investment office here at TD Wealth, is, we are the purveyors of building and managing diversified investment portfolios. So in the last few weeks, I was kind of sitting back and going, there's so much discussion around correction. I don't see a correction. I don't see them across our models. I don't see them across our portfolios. And I went, what gives, And so, really started to dig into it. And of course, I see the technology and the technology movement, but the reality is this unwinding we're talking about is what I would call a massive retail unwind of the technology trade. And folks that are, over-levered, speculators into Bitcoin and anything that is an AI or an AI beneficiary, that's what we're seeing. If we were looking at what this correction would be, first of all, we don't have any early signs of a recession going on right now. We don't have a break in liquidity. There's lots of it inside the market. We're not in the middle of a credit crisis. We are not in the middle of seeing a reversal of a CapEx spending. And ultimately, as we have seen the earnings season we just went through, we don't have deteriorating earnings either. In fact, we're in an incredibly buoyant time for earnings. So I think if you look at it in those terms, is that what we're seeing is, again, to hit this home, is there is this speculative phase that's going on in this market, and this speculative phase is, folks are discovering that, if you're really using a lot of leverage and you're chasing one sector of the market, and there's a lot of froth in that market, the net result is, and I think we're looking up here, we're looking at here, the run-up in Bitcoin and the run-up of, we're looking at a NASDAQ, so NASDAQ, 3 times levered NASDAQ, and looking at the run-up and looking at the drop-off here. And so, and on the bottom one, we're looking at the S&P 500, and we're looking at margin debt and margin calls. And all of that is, I would argue, is first and foremost, the good news is it's very orderly, and it's in a concentrated part of the market. But I think you certainly could not call this a major market correction in any way, shape, or form.
All right. Now, you identified 2 stabilizers there for the markets in liquidity and earnings power. Are they still intact?
Yeah. Look, and I should probably say, that on my way over here, we've published our monthly perspectives, and our monthly perspectives is called Gravity Always Wins. And much of what we're here is coming from there. And so, folks who want to read it is early when it comes out. You can go to my LinkedIn and you'll find it there. And so, if you look at it at an environment like this one, what ends a market and what ultimately leads to a market correction is either 2 things. One is you look at liquidity in the system. And when you look at the system today, there's ample liquidity. In fact, I think if you went back over the last couple of months, and if you said inside the major part of the indices, where we're seeing the hyperscalers go through a correction, you could actually argue it's been a very orderly correction that we're going through there. And the starting point of that is that we can look at something in the central bank in the U.S. and look at their net margin levels. And if we look at the net margin levels in going through September, October, and November, money was tightening up inside of there. And as that money is tightened up a little bit, we saw a little bit of a price correction in the overall market as a whole. When we look forward to going into December, we know all the discussion around the central banks and the U.S. saying that there may be a drop of interest rates by 25 basis points in December. Even if there's not, they've well telegraphed there's 3 coming, either in December, 1 in December, and then 2 more next year, or 3 next year. And they've also been telegraphing that they're going to be loosening up on the quantitative tightening. All of that points to more liquidity coming. And I think if you look at the massive fiscal spend that is out there in the U.S., if we go into the 2026 and when we start seeing those tax cuts from the One Big Beautiful Bill Act start to come out, ample liquidity in the system and more of it coming. And then on the other side, when we look at earnings growth, if we look at the S&P 500 for 2026, roughly you're looking at earnings expectations of, let's call it somewhere around 13%. You go over into Canada, you're somewhere around 10%. You go into Europe, you're somewhere between 8 and 9%. That's a really good, consistent earnings story that we're looking and talking about there. And I think that as long as there's ample liquidity in the system, and on the other side, as long as that there's really, really healthy earnings growth, that the likelihood of a big correction or of this market going through something, devious or ugly, is rather low. And I think it's important that we keep mindful of that.
When we talk about volatility in the markets, as you mentioned, explain to us how the rise of quant funds, as well as retail investors, has been driving that market that we've seen this year.
Yeah, look, that I don't want to lay this whole correction on the footstep of retail trading, but boy, you gotta say if it's not the catalyst to it, it's been the facilitator of a bigger rush down. So what we're looking at here in this chart kind of hits it all home. We have gone through a massive shift on what make markets tick over the last 4 years. So we're looking here is the investors in retail, high-frequency quant funds, and fundamental investors. So if you look over at the 2010, how much of the market was made up of fundamental investors? Look over to your far right, and how much of that is now made up of fundamental investors? Go back to 2010 and look at the difference between retail and high-frequency quant, and look over on the other side there. So give you some hard numbers on this. Going into COVID, triple-levered ETF mandates or products that you could allocate to was roughly $45 billion. Fast forward today, it's about $250 billion. That $250 billion swings in the market every day. And what it's doing is it's disproportionately having retail swing inside this market. And what we're looking here on the screen here is it's having that impact. What we're looking here is we're showing that liquidity flows and the GS retail favorites basket. And that is basically retail favorites basket of a lot of either tech-oriented names or companies that actually have pretty weak balance sheets, but have momentum behind them and leverage behind them and some sort of reference towards AI one way or the other, or Bitcoin, either of those two things. And so we see that liquidity push on it. What we're looking there is that's that Fed asset number I was talking about. You start to see it decline, and you start to see the retail favorites start to come off. So retail and this absolute massive change that we've had through the use of levered products and platforms and direct platforms and all of those things have had a significant impact. And now what we're seeing is, think about your average. I admit I'm a massive sports fan. I never miss a Raptors game. And every single time when I'm watching a Raptors game and every 5 minutes a gambling thing comes on. I must admit, I black out. I try to ignore it. The intersection between markets and gambling, right now we see the commodity exchange and negotiations, how they can link up and do business with FanDuel.
It seems that the lines between investing and betting are blurring.
They absolutely are. And that is all kind of coming to the push of what we're seeing today, is that this intersection of these two are starting to have an impact on markets.
Is that what's driving that speculation that you talked about and that volatility?
I think the driver between it ultimately is has been that as we've left COVID, we kept the foot on the pedal on keeping liquidity out there. Liquidity, as we just talked about, is one of the main drivers, right? Then you kind of click in and you get all this new era talk, all the stuff about AI and the difference in there. Then you throw in this kind of Bitcoin story and you get those mix. So all of a sudden you get an awful lot of people either saying, look, why should I work? Why do I need a steady paycheck? I can stay at home. There's very low volatility on this, and I can trade these things all day. So we've seen this massive change in movement inside of the market. And I think if you add up all those pieces, that's very symbolic of the market that we have today. And so when we sat back and we looked at it, is that I think, and what an awful lot of folks are discovering right now is, and it's back to the article we published today, is gravity always wins, is that, when leverage comes into the picture and it starts to go against you, what happens is that you start seeing a market, and right now it's a narrow part of the market, where one, liquidity starts to dry up. Two is that everybody says, well, geez, I've got to sell. Everybody starts to move for the exit at the same time. And I think that's what we're in the middle of a little bit here anyways, in what I would call kind of the AI beneficiaries coming to the end of the major market, but in the speculative end of this has been a major and significant factor. I mean, we've seen roughly somewhere between $2 and $2.5 trillion wiped out in this part of the market. That's no small sum.
Okay, so with that backdrop, what should investors be thinking about or doing right now? What should they be keeping at top of mind right now?
Well, I think that the starting point is that I think you got to step back a little bit, and I think you have to say and understand the difference between speculating and investing. And I'm not make this sound like speculation is all bad. It's not. That if you look at, we've been writing an awful lot about that. We think that artificial intelligence that we're in the middle of, this is the fourth industrial revolution we're in the middle of. This is a really significant period of time. If we went back in time, if we looked at the internet build out, if we looked at it let's call it in the 90s, if we looked at the television build out in the 20s, if we looked at the railroad build out of the 19th century, all of those had speculation involved in it and helped build an incredible amount of infrastructure in the systems that you and I benefit every day on. So I'm not saying, all speculation is bad. What I'm saying is that confusing those two when you're an investor is that typically I think what you need to do is take your net worth, put it on one piece of paper, and then look at that and go, okay, what is the money that I'm using that are for my long-term objectives? And what is the money that, and then the other part of the money is going, what is what I call the bag of chips money, right? The money that is, that if I lost it all, I'm all good with that. And I think if you do those two things, clearly delineate the difference between those two. Don't kid yourself that being levered long a triple Qs is an investment, but it's a speculation on a tech side of a market, and then understanding over here on your positioning and portfolio positioning, there. Create a wealth plan for yourself. Say, what is the cash needs that I immediately need to fund? What is the things that I want to invest in so that I can reduce the taxes and how the income that I'm deriving from my investments? What part of the investments am I using for the stuff I want to invest in 5 years from now? And then what is the stuff that I want to make sure that I'm investing for 10 years and longer out? And I think if you do those pieces, you're in really good shape.